Hello, everyone, and welcome to Quantum Marketing Radio. On this episode, we're going to be talking with Kirk Stafford. He's well, I guess maybe we should describe your background because it is pretty diverse.
Yes.
You've been in the investment business. You were an investment banker at one point, or?
No, I own a registered investment advisor.
Okay.
So I'm actually the portfolio manager. We run an option strategy.
Yep.
It's very specific and we think great, but
yeah. Okay. Well, and the reason we have you on today is because you've actually created a really unique product for the marketplace that I think a lot of people, one, are going to be really excited about, and two, find a lot of different uses for it that really can help their clients and actually create some new opportunities in their planning with their clients. So
yeah. We several years ago we started using insurance as a kind of a bond substitute.
Okay.
And I loved it as that for many years. And then about 4 years ago, we ran into a strategy that we like to use, and we wanted more. We couldn't get our mitts on enough. Personally, I couldn't get my mitts on enough policies. And then it dawned on me, there's a lot of good policies out there that are just wasted. They just, people surrender them for whatever reason. Either they need the money or, they just can't afford the premiums anymore. A host of different reasons. They want to invest in real estate or whatever, and they've decided that permanent insurance isn't needed anymore, or they just can't have it, they can't afford it. So that's where the light bulbs kind of dawned on me that and came on that there's a lot of people that would love to have that conservative cash value growth and don't have access to it.
Right.
And so that's where the idea generated.
So the alternative to a short-term bond fund or a money market fund came about by saying, hey, these are super valuable assets that people are just disposing of for the most part, that we could really capture and recycle. I think you've used in the past as a term, where we can put those to good use again, and at the same time compensate the current owner of the policy for it. And I'm sure some of you watching this are thinking, this sounds a lot like a life settlement, but not exactly. What is this thing? So we'll probably get a little more into that, but maybe describe a little bit what it actually is without, boring everybody with the minutia. We'll get into, what can it do? What is it? How does it work? What does it do?
Yeah. Well, we call it kind of the anti-settlement settlement. And the reason for that is we consider it technically a life settlement because it falls close enough into that category that we just want to make sure, we just want to make sure that everything is white glove, all the regulators are happy, and there's no one that could, get into trouble in any way with what we're doing. So it's the industry is very highly regulated, which is good because we know exactly what we can and can't do. And so that clarifies everything. That's very nice. And, but basically it's people buy these policies usually for two reasons. They want a permanent coverage. They want permanent coverage for their families. And then they want a conservative place to grow their money outside of the market. And for whatever reason, one of those, the conservative growth piece, is either something that they no longer want or can't have anymore because they just can't afford it. But everybody wants to cover their family or charities or whatever, right? So we thought, well, we have investors that aren't really looking at making money on their death or their demise. And so they just want that conservative growth as a bond substitute. So
at this point, the whole idea of buying the death benefit, that's more of the traditional life settlement market.
Exactly. That's what they're looking for. They're looking for somebody that's older, that's going to die maybe in the next 5 to 7 years.
Has some health issues, obviously.
Health issues. Very different mindset. And that's when they get paid. That's the only time they get paid, and they have to get it right. They have to guess, when they're going to die. On average, they have to get it right.
It's a trickier model for figuring out when that life expectancy is going to pay out for them.
Yeah,
Yeah.
it is. And so with us, it's very different. It's kind of the polar opposite. We just want to step into that cash value growth piece. And that's the piece that they don't want anymore or can't have. And so what we do is we simply pay them typically what the surrender value is, minus transaction costs. There's some fees to settle the policy. We pay the agents. Your folks would be happy to know that.
Yeah, for sure. That's obviously an incentive to talk about it, for sure.
Absolutely.
As well as being a great solution for the consumer, but.
Of course. Of course, yeah. And we'll get to that, I'm sure, but it's good all the way around. It's good for everyone, including the insurance companies. It keeps good policies on the books for decades, typically.
Right.
So,
and they get to make a profit along the way, at least, and that makes sense for them.
Yeah, exactly. So our fund comes in, we buy the policy. Technically, we own the whole thing. However, what we do is write in the contract, we make it so that the seller gets to retain the entire death benefit minus the last known cash values. So just as an illustration, let's say it's $1 million death benefit policy. It's worth $100,000. And their choices then, if they've decided to surrender this policy, is to get the $100,000 and walk their merry way, maybe get some term insurance or something like that. Or we can step in, have our fund buy the policy. We'll typically pay depending on the policy, and once we've got an illustration, we can tell you exactly how much, but typically it's going to be somewhere around 95%, give or take. And then out of that, that's where the life settlement provider gets paid to settle the policy, and then commissions, all that, or referral fees, however you want to call it.
That's where the agent gets paid.
Agent gets paid, exactly. So they actually get a little bit less. In this example, they get $95,000, but the fund will continue to pay the premiums and keep that policy in force. So the agent that sold the policy continues to keep his persistency bonuses and persistency ratios high, gets trail commissions, gets paid if they're the one that referred the policy.
Sure.
And then for the rest of their life, they now have coverage that they don't even have to pay for. So
they don't have any additional premiums due at this point if you're the consumer.
Yeah.
You still get to keep that death benefit that you were just going to get rid of.
Yes.
And you got your cash out of the policy.
Yeah.
Okay, that sounds too good to be true. So what's the hook?
It's just a really good marriage between people that now want the cash values and don't care about the death benefit. If I'm assuming you're 25 years old still, right?
Yeah,
so,
I wish.
All right, so even if you're 50, you still probably have 40 years to live, right? Investors aren't wanting to wait. Our investors aren't wanting to wait 40 years before they get a payout. They're happy as a clam, getting way more than they would in a short-term bond fund, just on that cash value growth. It's outside of the market. For the investors, you just can't find anything like it. That's
a great combination of a really safe investment vehicle, because it's secured by professionally managed bond funds at the carrier in their general fund.
Yeah.
And with a high credit rate companies, typically I would assume that's what you're looking for, is better rated companies. Yeah. And then you just have this liquid source of high yield, safe return.
No interest rate risk, no credit risk, no volatility. As far as an asset, it's awesome. And the funny thing about it,
than a normal bond fund. From a lot of
different.
A lot of risks. So
yeah, totally different. Yeah. Next to a treasury, there's not. It's the banks consider it a tier 1 asset. It's like cash.
Yeah.
And so there's banks go out of business, insurance companies do not.
Right.
So I mean, some would argue that it's even more secure than a treasury, although technically that's not the case.
Yeah. Right.
So, and what's interesting there from the investor side on the fund is we can't get a hold of these policies. The fund can't go out and say, hey, give me $2 billion worth of these insurance policies. You just can't do that.
Right.
You have to have a live person and an insurable interest to get it. And so, which, by the way, the policies that we buy have to be at least 2 years old, because we don't want to get into any sort of STOLI, which is stranger originated life insurance situations. We don't want to buy, and your agents you want to make sure that they're never selling a policy with the intent to sell it to the third party. We're coming in when people have already gotten these policies for whatever reason and have decided that they can't have it anymore. And so we're just really simply saving the situation from really a bad and sometimes ugly time where they've maybe put some money into a policy for whatever reason, they got to get out early, sometimes even at a loss. And so this really saves that whole situation, because now, going back to that example we had, you've got somebody that maybe is taking a little bit less as far as their surrender value, but now think of how much money they're going to save each and every year for the rest of their lives. And at some point, we all have a 1-in-1 chance of dying, right? And so having, let's say they get hit by a bus 2 months from now after we purchase it. Their family is still going to receive $1 million minus the cash values, which is still going to be about 100,000.
Most of which they've already received.
And they've, yeah, exactly. And so now they're going to get another $900,000. That's huge.
Yeah.
Tax-free still.
Yeah.
So it's huge for them, and it's good for us. I mean, it really is. The reality is, in most cases, we are going to have that policy for the next 40, 50, 60 years. And that allows us to get above average returns, especially considering the risk. And yeah, everybody's happy.
So the issue is obviously for the investor side is securing these policies that are out there. How big a market is it? I mean, how many policies are, people lapsing every year that you could buy?
Great question. So these policies are everywhere. According to our estimates, just based on industry reports and things that they put out every year, there's about $30 billion with a B, $30 billion worth of cash value that's surrendered every year.
Wow, that's the cash value, not the death
That's
benefit.
the cash values.
Okay.
Now, it's massive. Out of that, there's going to be a number of those policies that probably never should have been written with companies that really aren't in the whole life or IUL business. And it's kind of a side note to their main operations. Those policies aren't going to be anything that we're going to want to buy. But we estimate that probably anywhere from 10 for the very best percent to as much as 50-60% is what we're looking to buy.
So that's a much higher percentage of policies that you're actually going to look at and price that'll actually work for an offer versus a traditional settlement where it's a bit of a needle in the haystack there.
Exactly. And also comparing the two, there's no comparison for a couple different reasons. With a normal life settlement, you've got a long time period before you tell the client how it works. They decide they might do it.
They've got to get medical records, life expectancy reports, and
you're dealing with people that are aged. And so now you have to worry about senior issues and family members and just there's a whole host. You can jump through all those hoops and then find out, oh, she doesn't qualify.
Yeah.
Or actually she decided to keep it,
didn't like the offer, or family felt it was better to keep the death benefit. So now there's all these other dimensions to making that decision. So let's take forever and close at a low rate by comparison to what you're offering. And I think I want to circle back real quick. You mentioned something earlier. Obviously, we're dealing with cash value policies. That's typically with a lot of cash in them. That's typically not something that a traditional life settlement market would be interested in, right? So usually pretty tough to settle a whole life policy unless you're
very difficult,
very old and very sick.
Yeah.
And that's not the case here. They could be perfectly healthy and 25 years old.
Yeah.
And that's your perfect box.
Yeah, and we can take older people. we just don't care.
You don't care what the age range is,
Yeah.
but the longer you can hold it, obviously, it's
Yeah.
easier for you.
Our poster child is a 20-year-old that's going to live forever
Right.
in perfect health
Right.
with a great mutual company that's paying high dividends. Yeah, that's our poster child.
Yeah,
But
so
the reality is,
it'll see a mix.
70-year-olds, 75-year-olds, we priced one just recently, I think, with you that
Yeah.
She was what, 76 or something, I thought.
Something like that. Yeah.
But anyway, yeah, the whole range.
Yeah, and it's so I guess that's the other thing. So it's not only whole life, which has typically been kind of a difficult policy to settle. IUL is also in that mix, right?
It is in the mix. Currently, we're keeping it to about 15% of the portfolio.
Okay.
We want the portfolio to be extremely steady. We like IULs because they have more potential, but there's going to be some years where they don't perform at all. And so we want, for the fund, we want it to be very steady. So
a little bit of upside potential in the portfolio is fine. And
exactly.
Got it.
Exactly. That keeps us, clicking along in the bad years and more than clicking along in the good years.
So anyone listening to this podcast today, I think the big thing for them is that when you have a consumer that maybe for whatever reason isn't happy with their policy, don't want their policy, or can't keep their policy, that it's a valuable asset, even if they're not sick and they're not old, that they could sell on the secondary market and get their cash and still get to keep the death benefit and not have any premiums.
Exactly.
Which is a fantastic offer for them. And then they can use that freed up cash for whatever they want, whether that's investments or expenses or whatever. It's wide open. The advisor could help them redeploy it in some other asset if they want.
Yeah, so think about this from an agent's point of view. Somebody comes into my office, I'm reviewing what they have. Instead of saying, hey, this policy's mediocre, what you've done in the past with your other advisor isn't good, now I'm going to have this tug of war with you to show you how what I've got is better. You're going to be questioning whether my motives are altruistic or not.
Sure.
This way you can look at what's happened. You can say, hey, I like what you've done here. It's definitely a step in the right direction. However, for instance, today's new policies have some features in it that the old ones didn't. This old policy was good at the time. It was decent at the time. There's something that's now even better and more appropriate for you. Instead of just surrendering this and 1035ing it into this other policy and then not having the death benefit, any of the death benefit of the previous policy, now you can say, hey, let's settle this policy, get you the new policy so that you've got all the bells and whistles, long-term care, all that kind of good stuff, better potential rates of return. And then now this old policy.
And potentially living benefits like a long-term care accelerated benefit rider, which you didn't see in a lot of the older products.
Yep, exactly. And they get to keep the difference between the death benefit of the old policy and the cash values of the old policy.
So now they might have
hundreds of thousands of dollars typically.
Yeah, so now they might have, maybe even double their death benefit if they redeploy those dollars into a new policy and they're keeping most of the death benefit on the old one.
Exactly.
So they're increasing their overall coverage, maybe adding features, adding better performing policy to their mix. So obviously there could be some issues with I know some carriers don't like the idea of a policy being settled, so in acquiring that new coverage, they might have to have that in place before they did this transaction. So they might want to have it priced first, see if it makes sense to do it, and then get the other coverage in place. Is that kind of a?
Yeah, to be on the safe side, when you're doing the new app, tell them what your plan is. What we're doing is very different than a normal life settlement. And so, there's none of the stranger originated life insurance. There's just a few things that the carriers want to be comfortable with, that this is the right thing for the client. And there's really not a good alternative other than to do this. And the reality is there is no other alternative.
Yeah, I was going to say, this is a one of a kind. This is your proprietary program. So
yeah. As far as I know, there's not anyone in the nation that's doing anything like this.
Great. So yeah, I mean, other than the carriers might have some objections to a settled policy because this isn't a traditional settlement in any way, shape, or form, really. They may not have the same objections. They're just kind of asking those questions, assuming that everything that is called a settlement is a settlement in the way they perceive it from a regulatory standpoint.
Yeah.
What's been in the market for 30 years or whatever the time frame is. So so how long has this been around? I guess maybe you said was it 5 years ago you came up with this idea, and then it sort of evolved into
So about 4 years ago is when we ran into the idea. Actually took a couple years for us to get some of the licensing and jump through some of those hoops.
Yep.
We wanted to make sure, of course, that every last tire was kicked, so to speak. We looked under every last little piece of it to make sure we were good with the regulators, and that we knew our parameters and what we could pay for a policy. Just making sure that there's not a scenario where somebody ends up shorthanded or anything like that. And that's one of the reasons why we believe that this is absolutely the right thing to do for a client, is because they literally get their cash now and get the benefit that they normally would have just been wasted. And so it's good for everyone. We started buying these policies, I guess it's been about 2 years ago.
Okay.
I started buying these up personally. It took us a little while longer to get the fund put together. That's a whole nother set of hoops to jump through. And there's nothing else like it. And so we had to, we get the best attorneys and fund administrators and all that kind of stuff together so that we can, the auditors, there's
so putting together the investment side of this was obviously another complicated piece of it, not just the acquisition of the assets that become the place where the capital is deployed for the investors. So
exactly. So that fund's been in place for about 5 months is all now.
Okay.
And so, but we're up and running. We've got capital, and we've got quite a bit of capital. And so we're looking to
see if we can find
the best policies.
Right.
Exactly.
Right. So obviously that's a call to action for everyone out there. If you are watching this podcast and you have a client that has a whole life policy or maybe even an IUL policy, they don't have to be sick. They can be basically any age, right?
Yeah.
20 to 18, I suppose, in theory, 18 up, and have cash in there that they want to, and they don't want the policy for whatever reason.
And not even necessarily a lot of cash. If it's a newer policy they've had for just a few years, it may not have a lot of cash in it. That's actually okay for us. In many cases, that's all right. The size of the policy, it doesn't have to have any sort of minimum per se.
Transactionally, there's probably a minimum where it makes the most sense to have at least a certain amount of death benefit.
Probably a couple $100,000. It just depends on the situation. But probably a couple $100,000 a death benefit.
That gives you at least room to put some money in the policy. If it's lower than that, you don't really have a great vehicle to put monone into it. So that's the issue. And transaction costs are still probably similar every time. So
well, and so one of the things that's really nice about this is from the agent's side, that it really only takes a few minutes of their time. If they're the agent, they can run an in-force illustration in a matter of a few minutes, shoot it over to us, and we can know exactly what we want to pay, what it would look like for the seller, and what it looked like for the agent. We can know all of that in a matter of a few hours.
So the proposal turnaround is really quick. If they can get you an in-force illustration, they can have a sense of whether or not this is a valuable policy for you and your firm. Same day or same week at least, which is 1,000 times faster than a settlement, traditional settlement.
And then explaining it is also extremely simple. This is what you're going to get paid. This is what you get to keep and retain for a death benefit. And if, for instance, we ever decided to sell the policy or anything, they have the ability to buy it back. Here's the contingencies, you know, because they always want to know, well, what if?
Right.
We've gone through all of those what if questions, and we don't have any intention of ever selling these policies. That being said, we want to make sure that the seller is protected and their family's protected. And so we've got some provisions in there in place so that if we ever did, for whatever reason, decide to, you know, quit the business or whatever, and there was no market for it or anything like that, to keep those benefits in place, we want to make sure that the seller has the opportunity to get that policy back and keep the coverage.
So that would be in the unlikely event that you exited the business and
Right.
that portfolio of policies had no value, which
Yeah.
of course would be unlikely. The market's out there probably going to look at that and go, this is great, there's plenty of value here. But in the unlikely event, they still have that right of first refusal. Basically, they can buy the policy back and take ownership of the death benefit again and continue paying it if they wanted to keep it.
Exactly.
Without having to worry that it's just suddenly going to be gone and they didn't hear about it.
Right.
Yeah.
Right.
So a lot of mechanisms are built into this process to protect the client.
Yeah.
In the end, the seller.
Yeah.
So.
One of the other things, just while you were talking, I realized from an agent's point of view, knowing that we exist, and they're going to run into policies. I mean, it just happens in the course of business. You're going to run into people that
if you do annual policy reviews, or if you meet new clients and you start seeing what their assets are, you're going to find stuff.
Absolutely. But knowing that we exist, think about how that changes the mindset of someone looking to buy a policy.
Mm-hmm.
Not that, of course, you don't want to sell it with the intention to sell it to us, but knowing that companies out there, that there is a fund out there, that's all they're wanting to buy, is just not the death benefit, just the cash values. And they're willing to pay the premiums just for the cash value growth. That reinforces the value of these policies, especially in today's market, but at any time, for their conservative nature and some of the benefits that they have. So that, in my mind, really cements with a client the true value of what they have here.
Right. I think a lot of people that own life insurance and for whatever reason aren't happy with it, or their advisor tells them there's an opportunity cost of having done this and you should have done this instead. And they can go into that situation and say, you know, this is a valuable asset. At all times, they can say this is a valuable asset, and that's a much better positioning than having to say, you know, I'd probably just surrender that thing. Now they run into a potential lawsuit if they surrender a policy and their client dies in a week or two from who knows what accident, and they had advised that client to surrender that policy to redeploy the cash. This time, they don't have any of that liability because they still have the client still has the death benefit.
Yeah.
So.
And you know, from time to time, this is kind of cool, I think. It's not cool for the fund because we don't get the policy, but occasionally someone has a perfectly good policy. It was a great plan originally that they had, and for whatever reason, their Edward Jones guy or somebody came along and said, hey, you gotta just buy term and invest the difference, and then put your money into a bond fund paying half of what you were getting. I don't know why that makes sense, but
right.
Because you got to be diversified, right? So
right.
Anyway, so they come up with this plan, and they're like, okay, well, my dang brother-in-law sold me this policy. I'm not going to speak to him anymore because he sold me this dumb whole life policy. Well, the reality is that dumb whole life policy is very valuable. And as they kind of question why this sounds too good to be true, why are you doing this? As they find out why we're doing it, it causes them to reevaluate and go, well, wait a minute. Actually, this is a good policy.
Why would I want to get rid of it?
Why do I want to get rid of it?
Right.
And sometimes they don't. And and that's good. That's fine. You know, that's a good day for you, the agent. It's a good day for the client to know that it's that's the case. But the reality is there's all kinds of situations where they just need the money, or they, you know, for whatever reason, they've decided to do something.
So what's the most common scenario you've seen? Is it just somebody was ready to surrender because their policy was maybe overloaned, or was it you know, they couldn't pay the premiums? Is that the most common, or is it that somebody just says, hey, I just don't want this thing because my advisor said this wasn't
Yep. So
a good place to put my money?
We get a little bit of everything. So we get the guy that says, hey, I just want to buy term and go invest in real estate or stocks or whatever. So we get that. We do get a lot that, you know, is a good plan originally, but then, you know, their business took a downturn, they borrowed out the cash, now they can't pay the premiums and it's about to lapse. We see that. And then some, you know, sometimes they got the insurance for maybe for the death benefit, buy cells, key man, a spouse that has now passed away, and so they're not looking at the death benefit at all, and they just want the cash to go, you know, buy a house or whatever. Mm-hmm. And so so those are all reasons why we'll pick them up. A lot of times, and this is kind of where the gold nuggets are for the agents. A lot of times they're good policies, but they're not as good as what's currently available with all of those long-term care riders and things that you mentioned.
So there's opportunity for the
There's
agent
huge opportunity there, because these are your clients. They already trust you.
Right.
And you don't have to now go to them and say, oh, by the way, this was a bad policy I sold you. Now I want to sell you something else. You can go to them and say, hey, look, this was a really good policy for its day. They now have some other features that are even better.
Yeah. And
we don't have to get rid of what you're doing. You can actually keep the best part of what we did previously and then tack on now these other benefits and things. So it's a really good day for you, the agent, because you're going to make some money. Mm-hmm. And then, of course, it's great for your client.
It's just positive reinforcement that the plan that they had was already good. So we should probably talk about tax ramifications of this transaction. Yeah. If they have a lot of gain in their policy, does this always make sense? Is it kind of the advisor needs to look at the numbers on that, or what's the?
All right. So here's my disclaimer.
All right.
I'm not a tax accountant or attorney. Can't give tax advice.
By the way.
Yeah. So. However, this is what we've been told. This is how we understand it, is that when you sell the policy, there is a transfer for value there. The death benefit that they keep, because the death benefit was, or the insurance policy was originally obtained with an insurable interest, that's still going to go tax-free to their beneficiaries. Exactly. Yeah. But the value of that is going to be, if there's a gain in the policy, that's going to be a taxable event as far as we understand it. And so that's something that you have to look at and factor in there. Now, if you're going to surrender it anyway, then you still have the same problem, right? So there's no difference there. In some cases, in fact, we're looking at one with you right now, where we may, instead of actually buying the policy, we may do a non-recourse loan. In other words, they're not liable to pay it. And essentially, we loan against that. We get them their money. We take a collateral assignment. There's no transfer for value in that case, and so there's no taxable event. And then the value of that loan, as it accrues interest and grows over the years, is still capped. The principal's capped at whatever the cash value of the policy is. So it's essentially, it's the same exact thing. We don't like to do that. It's not as good for the fund. We don't have as much control over it. It's a way for you but we will do it in certain circumstances.
So this is sort of a different product in the mix, that if for some reason it doesn't work with your standard, and that we should probably name what that is. What do you normally call it? Is it I know we've gone back and forth with this, but we've been calling it a cash value buyout, but
yeah,
I don't know. Do you have a preference for name?
We need to come up with a really cool name, you know, something that really rings. You know, you got Uber, you got Google, you got all these names that come to mind, and I don't know. We're numbers geeks. We're not, you know.
Right. Haven't figured that piece out, but that's the working name, at least at this point, which is also descriptive of what it is. So there's some practical reason for using that, I suppose. It makes sense in the short term. So maybe we'll call that the technical name of it, and There'll be a marketing name later.
Maybe we could have like a drawing, you know,
Yeah, right.
somebody gets a trip to Hawaii if they give us the right name.
Right, right. Well, I'm sure people are probably excited about what they're hearing just because this is a cool innovation. You know, you've brought something unique to the market that gives them a whole new tool in their toolbox to do all kinds of different things that benefit the client and potentially generate one or even more commissions for the advisor.
Oh, absolutely.
While helping their client. So that's a win-win for everybody in the whole scenario.
Yeah.
Pretty cool. Pretty cool. I'm going to just check our time here quick just to see how much time we have left here. We're about 35 minutes into our 40-minute interview here. So what else haven't we covered? What else do you want to mention about this? I guess one thing I think we haven't covered that we should bring up is that this is now something you can do in every state. So until recently it was somewhat limited. But
very limited.
Yeah. So now
we've got some great partners now that are licensed in the various states, and so we can get it in any state. You know, we never talked about the time frame.
Yeah.
Obviously, every situation is a little bit different, but we can literally have the whole deal done in less than 2 weeks.
That's cool.
Yeah.
Yeah. So that's
not fast. 2 years, 2 weeks.
That's fast.
So it's very fast.
Anything involving life insurance that takes 2 weeks or less is pretty crazy.
Yeah. Yeah. It really is simple and streamlined, and you'll know whether it's something that makes sense or not in just a matter of a few hours normally.
Well, even we have a lot of annuity agents that work with ECA marketing, and even a typical annuity probably takes more like 30 days from, you know, app to issue.
Yeah.
So this is pretty quick.
Yeah, and I will say that we don't want all policies. It's got to be a decent policy, and so I'm assuming you'll have some sort of a link or something so that they can get to the calculators and see how to know if they're in the right ballpark or not.
Yeah, we're going to have a tutorial available with some more in-depth videos that you and I have put together so they can learn more and answer some other questions. But this is just kind of an introduction. So
yeah,
anybody watching the show today, they can at least now know about it and know that you know, they can learn more and actually get a case submitted and get it priced and that sort of stuff. We'll have some tools for them to
just a couple calculations, and they'll know whether they're in the right ballpark or not. And that way they're not wasting their time, their client's time, our time, yours.
Do you look at companies that are anything other than an A-rated company for your portfolio?
We'll look at pretty much anything.
Okay.
We want A and better, but we'll look at it.
Yeah,
absolutely.
So if it prices, you might consider it if it has a high internal rate of return.
It just has to make sense, and there's a difference between the crediting rate and what that policy is actually earning each year.
Yeah. So for you guys, you need to earn a certain amount. If the policy says it's earning 4%, and you need to earn 4% on the internal rate of return of the policy, those are not the same thing, right?
Yeah, a crediting rate is different.
Yeah.
So the companies will announce a crediting rate. The actual performance of the policy is always less than that.
Yeah.
And that, unfortunately, that still surprises a lot of agents. But if you run the numbers on what it's actually growing each year, that's what we're looking at. We don't care about, they could say it's 20%. I don't care if the company says it's a crediting rate of 20%. If it's only making 3%, I don't care what they tell me the credit rate is. Exactly.
Yeah, exactly.
Yeah.
So it has a lot to do with just the pricing of the cost of insurance and how the dividends are performing and all that. So
whether it's a Sunday in June and a full moon, I don't know why, but it seems to, it depends on the policy, and you know that just by running an in-force, you can tell, okay, this is exactly what we should expect out of this policy.
Yeah, so I guess that's the other thing, and although you will probably find a lot of them are valuable and that you'll be willing to make an offer on them, you're not buying everything. So it's still worth taking a look at because it's a very high percentage of them that you probably can make an offer on and can buy, which is way different than the traditional settlement market. So for those of you who've done settlements before or even tried to do a settlement unsuccessfully because you had to send in 100 cases and none of them priced, you're not going to have that problem here. You send in 100 cases, you're going to have quite a few of those where offers are made.
Well, and think about it.
Yeah.
So even if the policy doesn't price, what does that tell you about the policy?
Mm-hmm.
It tells you that you clearly need to be looking at a different policy for that client.
Right. It may still make sense to do something else with it. So
Yes.
they might still
Yeah.
initiate a 1035 and still have a new sale there. So
You've got a great conversation to have, because you can say, hey, look, this is clearly not doing as good as you could be doing.
Yeah.
There's a sale right there.
So the cash value buyout ultimately is a tool to help you sell more life insurance, no matter what you do, or annuities or other investments, at the same time helping the client preserve an investment that they made in a policy that might still have a lot of value for them.
Yeah.
So
absolutely.
Well, we are, I think, at the end of our time today. I know I probably could still ask more questions, but I think people have a pretty good idea of what it is. And don't hesitate to get in touch with Quantum Marketing System. And you can click on the link below if you want to get more information. We'll have a link there where it'll take you to a little portal where you'll be able to get access to a tutorial and submit cases. So thanks so much, everybody, for tuning in today. Thank you, Kirk, for coming to town and showing up live in our studio here.
Yeah, thanks.
All right. Thanks, everyone.